welcome to the deep dive. So today we are looking at something that, well, on the surface, it might just look like a really dense corporate document.
Right. It's a financial press release. Not exactly light reading.
Yeah, exactly. It's the Fiscal 2026 year-end earnings press release for Motorcar Parts of America, Incorporated. They go by the ticker MPAA, and this report is dated June 8th, 2026.
And we should say right up front, our mission for you today is to translate this thing.
Yes, absolutely. Because what looks like just a dry spreadsheet full of numbers is actually this incredible masterclass in pulling a business back from the brink.
It really is. I mean, it's a massive turnaround story.
It's like turning the key on a sputtering, coughing car engine when you're completely certain you're about to be stranded.
Yeah.
And then it just suddenly catches, roars to life, and, runs smoother than it has in years.
That's a perfect analogy, because if you look at the trajectory they were on just 12 months prior, the momentum was heavily against them.
Really heavily.
But hidden inside these margins and operating income lines is this gripping story about surviving a brutal supply chain and, capitalizing on the chaos of competitors to engineer a fundamental business turnaround.
Right. So to ground us real quick, Motorcar Parts of America, they manufacture, remanufacture, and distribute heavy-duty aftermarket auto parts, the stuff that keeps vehicles on the road across North America.
We're talking alternators, starters, wheel bearings, brake pads, rotors, that sort of thing.
Yeah, the physical guts of a car. But they also have a subsidiary focused on electric vehicle testing solutions for the automotive and aerospace industries.
Which is super interesting.
It is. So they kind of have their hands in both the physical machinery of today and the digital drivetrains of tomorrow.
Okay, let's unpack this, because the numbers they just reported for their fourth quarter are nothing short of staggering.
You really are. We are basically looking at a complete reversal of fortune here.
Yeah.
The raw data shows their Q4 net sales spiked 9.9% to $212.3 million.
Wow. And their gross profit soared 30.9% to $50.4 million.
See, the metric that gave me genuine whiplash, though, was their bottom line. I mean, in this single quarter, Q4, their net income hit $9.7 million.
Right, which translates to about 42 cents per diluted share.
Exactly. And that might sound like just a standard positive earnings report until you zoom out and realize that in the exact same quarter last year, they reported a net loss of $722,000.
A total 180.
And looking at the full 12-month fiscal 2026 period, the contrast is even starker. I mean, net income was $12.4 million compared to a deeply painful $19.5 million loss the year prior.
Yeah, so they essentially swung the pendulum more than $30 million in the positive direction over just a 12-month window.
Which brings me back to that stalling car engine analogy, because a 9.9% bump in sales is great, right? But you don't flip a nearly $20 million annual deficit into a $12 million profit just by, running a marketing promotion or pushing a few extra brake pads onto shelves.
No, definitely not. That requires a structural overhaul.
Right. So my initial thought looking at these numbers is that they must have drastically slashed their operating expenses, like mass layoffs or closing facilities. What exactly changed internally?
Well, what's fascinating here is the actual mechanics of their margin improvement. Because it wasn't about indiscriminately slashing overhead.
Okay.
It was about internal efficiency. They started keeping vastly more of every dollar that came in the door. So their gross margin jumped from 19.9% to 23.7% in Q4.
That's a big jump.
It is. And if you strip away the accounting noise, like non-cash expenses and certain one-time items, their gross margin actually increased to a really robust 25.8%.
Wow. So that is a massive leap in profitability for a heavy manufacturing company.
Absolutely.
But looking further down the income statement, there's an even bigger catalyst for this turnaround, right? Their interest expenses for the year dropped by $8.9 million.
Yes, that is huge.
Now, the report mentions lower interest rates across the board, which obviously helps any company carrying debt. But there's a specific phrase they use. They say, lower utilization of accounts receivable discount programs.
Yeah, that's the key phrase.
That sounds to me like they stopped taking payday loans against their own invoices just to get fast cash. Is that the primary driver here?
That is the exact mechanism, yeah. Accounts receivable discount programs, which is often called factoring, they are a lifeline for companies with cash flow issues.
How does that work exactly?
So imagine you sell $1 million worth of alternators to a massive national auto parts retailer. Those contracts often dictate that the retailer doesn't actually have to pay you for 60, 90, or sometimes even 120 days.
Right, but your factory workers still need to be paid this Friday.
Exactly. So you sell that $1 million invoice to a third-party financial institution today, but you take a steep haircut. So maybe you only receive $940,000 just to get that immediate liquidity.
Oh, I see. So you are basically sacrificing your own future profitability just to keep the lights on in the present.
Spot on. It is incredibly expensive capital. So the fact that MPAA reported significantly less reliance on these discount programs means their organic cash flow is finally strong enough to wait out those 90-day payment terms.
They don't need the payday loans anymore.
Right. They are letting the cash come to them naturally rather than paying a premium to access it early. And that shift alone stopped a massive financial bleed.
Man, that paints a picture of a much healthier balance sheet. They fixed the internal plumbing.
They did.
But a business doesn't operate in a vacuum.
Oh.
You have to deal with the volatility of your customers, the supply chain, global trade.
Oh, definitely.
And the report highlights some incredibly quirky operational challenges they faced, including CEO Solon Joff, noting that they achieved this record quarter despite a massive drop in ordering activity from one specific buyer.
Yeah, we are talking about an approximate $30 million sales decrease from a single large customer over the fiscal year.
$30 million. Losing $30 million in revenue from one source and still posting a $12 million net profit for the year, that almost defies gravity to me.
It's wild.
And to plug a hole that massive, they point to a very specific industry mechanism in the report.
Yeah.
They cite $19.9 million in Q4 and actually $35 million for the full year of, quote, core revenue in connection with the realignment of inventory at certain customer distribution centers.
Yes, that is a mouthful.
It really is. Now, to the average reader, realignment of inventory sounds like ultimate corporate speak. Like a company is just physically moving boxes from a warehouse in Ohio to a warehouse in Texas. Are they just moving boxes of alternators to different shelves? Or is this some kind of accounting trick? How does shuffling pallets trigger a $35 million revenue recognition event?
Well, it comes down to the fundamental accounting logic of the aftermarket auto parts industry, specifically surrounding this concept of cores.
Course, right.
So when a consumer buys a replacement part, like an alternator or a starter, they usually pay a core charge, which acts as a deposit.
Like when you buy a keg of beer and you have to bring the empty keg back to get your deposit.
Exactly like that. They only get that deposit back when they return the broken part from their vehicle to the store. That broken part is the core. And MPAA's entire remanufacturing business relies on those cores coming back to them so they can rebuild them.
So the original manufacturer, MPAA, retains a vested financial interest in those broken parts, even while they are just sitting in a retailer's distribution center.
Exactly the case. Those cores represent a massive liability and asset web between MPAA and the retail chains.
Okay, I think I'm following.
Because MPAA technically owns, or at least has financial claims tied to, those cores sitting on the retailer's shelves. So when a massive retail customer decides to realign their distribution centers,
Which means what exactly?
meaning they consolidate warehouses, shut down specific hubs, or maybe change their reverse logistics network, when they do that, it forces an audit. The retailer has to officially reconcile, return, or account for all those physical cores.
Ah. So the realignment forces an accounting true-up. The boxes might literally be moving, but the movement triggers a contract clause where the retailer essentially settles up with MPAA, allowing MPAA to officially recognize the cash value of those cores on their income statement instantly.
That is the mechanism, yes. It creates a sudden, concentrated surge in recognized revenue. So it is a genuine operational reality of their supply chain. It's not just paper shuffling, but it really highlights how dependent their top-line numbers can be on the internal logistics decisions of their biggest customers.
That makes so much sense. And it wasn't the only external hurdle they had to jump either. The report heavily emphasizes the impact of global tariffs.
Right, the tariffs.
They explicitly state they were paying net tariff costs for products they sold before their on-price increases became effective.
This is the ultimate macroeconomic squeeze play for a manufacturer.
How so?
Well, a new global trade tariff is implemented, right? And the cost to import your raw materials or your components skyrockets basically overnight. But MPAA has these long-term contracts with major retailers that lock their selling prices in for months.
Ouch. So you just have to eat that margin loss. The government gets its tariff money immediately, but you have to wait for the contract renewal window to legally pass that cost on to the consumer.
Yeah, exactly. It creates a punishing lag. But The crazy part is, despite the $30 million customer drop-off we talked about, and despite this painful lag in tariff pricing, they still improve their gross margins.
Right.
And a key factor they highlight for that is the increasing utilization of brake-related capacity.
Okay, now anyone familiar with manufacturing understands the basic concept of fixed costs. Like, a massive factory costs the same to keep the lights on, whether it's running at 40% capacity or 90% capacity.
Sure.
But the strategic angle here feels much deeper. By pushing their brake factory utilization higher, they aren't just lowering the per unit cost, they are building a competitive moat.
What do you mean?
Well, when you have the operational capacity to absorb massive, sudden orders that a struggling competitor simply cannot fulfill, you stop being just a vendor. You start dictating the terms of the market.
That is a great point. That elevated operational leverage is their strongest asset right now. And frankly, they are going to need every single ounce of that capacity because the competitive landscape outside their factory doors is undergoing a seismic shift right now.
Here's where it gets really interesting, because, surviving a bad year is one thing. But explosive growth usually comes from capitalizing when your competitor's ship hits an iceberg.
Yeah, and the iceberg has definitely been hit.
Right. And MPAA's fiscal 2027 guidance implies they are just preparing to sail right through a debris field of their rivals. I mean, they expect net sales to hit between $780 million and $800 million next year.
That's a 7.5 to 10.2% year-over-year jump.
Huge. And they expect EBITDA, which is earnings before interest, taxes, depreciation, and amortization, to land between $95 million and $100 million.
Those projections represent a profound level of confidence from the management team, and they explicitly lay out the catalyst in the report. They say the company has been awarded, quote, significant new business commitments. But there is a vital caveat in the timeline. They do not expect this new business to hit their balance sheet immediately. They project this revenue will rapidly ramp up in the second half of the fiscal year.
The delay there is the tell, isn't it? It reveals exactly what is happening in the broader market. The report notes that customers are currently taking advantage of liquidated inventory purchased from a previous supplier.
Yes.
It's basically a game of musical chairs in the supply chain. A massive competitor goes bankrupt, and their warehouses are just full of auto parts that get liquidated, sold off for pennies on the dollar to anyone who will haul them away.
And if you are an auto parts retailer, your fiduciary duty is to your own margins. You are absolutely going to feast on those deeply discounted liquidated parts first.
Of course.
There is zero financial incentive to buy a newly remanufactured starter from MPAA at full wholesale price when you can just buy a bankrupt supplier's starter out of a liquidation bin for a fraction of the cost.
Right. But the fatal flaw with feasting on that liquidated inventory is that it has a strict expiration date. It's like vultures circling a carcass. I mean, eventually the meat is gone.
Yeah, the well runs dry.
Once those liquidation bins are empty, the bankrupt supplier isn't manufacturing any new starters to replace them. So the retailers will suddenly find themselves backed into a corner, needing a reliable, high-volume partner to keep their shelves stocked permanently.
Exactly.
And MPAA is just sitting at the table with a napkin tucked into their collar, patiently waiting for the appetizer of liquidated inventory to clear so they can serve the main course.
I love that. And timing is everything here. MPAA management recognizes that attempting to compete with that liquidation pricing today, it would just be a race to the bottom. It would destroy their newly repaired margins.
Right, why discount your own stuff?
Exactly. So they are simply letting the market gorge itself on the cheap stuff while they secure the long-term full-price contracts for tomorrow. By the second half of fiscal 2027, that cheap inventory dries up entirely. Boom. MPAA expects their sales to skyrocket at that exact moment, projecting they will add more than $100 million in additional annualized net sales by the end of FY27.
$100 million?
Yeah, that pushes their total annualized run rate north of $900 million.
So synthesizing those new, massive business commitments with their newly discovered internal efficiencies, specifically, the fact that they are generating enough organic cash that they don't have to factor their invoices anymore, that creates the ultimate recipe for scaling.
It really does.
They can absorb a massive influx of new orders without crippling themselves with expensive short-term debt.
Right. They are positioning themselves to completely neutralize their working capital constraints right as the floodgates open. It is a highly aggressive, deeply calculated posture from them.
Okay, so with operations humming, a major competitor neutralized, and projections pointing to an additional $100 million in annualized sales, the obvious question becomes, What on earth do a bunch of executives do with that impending windfall?
Always the big question.
Which brings us to their capital allocation strategy.
Right. So the report lays out their current financial footing quite clearly. Over the last 3 years, despite the previous operational losses we discussed, the company actually generated $103.8 million in cash from operating activities.
Not bad.
Not at all. And their net bank debt sits at a highly manageable $80 million. But the most revealing move management is making right now involves their share repurchases.
Yeah, the buyback numbers are substantial. In fiscal 2026, MPAA bought back 955,608 shares of their own stock for $11.4 million.
Yeah.
That averages out to about 11.88 per share. And they actually accelerated this behavior right at the end of the year. In Q4 alone, they repurchased over 286,000 shares for $3 million, averaging just 10.48 a share. Furthermore, they still have $22.1 million left in their authorization to keep buying.
So they're systematically removing their own shares from the public market.
I have to offer a hypothesis here, though, that might push back on that strategy.
Oh, okay. Let's hear it.
Because earlier, we established that MPAA owns a subsidiary designing electric vehicle testing solutions for the automotive and aerospace industries.
Right, the EV stuff.
That is futuristic, highly complex technology. If they want to survive the next 20 years, why spend over $11 million buying back their own stock? Shouldn't a forward-looking management team be pouring every single available dime of capital into that EV tech R&D, rather than engaging in financial engineering to artificially boost their earnings per share?
Well, this raises an important question, and it really cuts to the core of how corporate finance operates in reality versus in theory.
Correct.
Because capital allocation is the ultimate lie detector test for a management team's true priorities. While investing in EV technology is obviously crucial for long-term survival, buying back stock at an average of 10.48 is the loudest, most aggressive signal management can broadcast to the market.
A signal that they believe the public markets are entirely mispricing their asset.
Precisely. Just go back to the timeline we just mapped out. The executive team knows for a fact that in the second half of 2027, the liquidated competitor inventory will vanish.
Right.
And those new contracts will flood their balance sheet with over $100 million in new annualized sales. They're looking at their internal data and realizing that their current stock price does not reflect this impending tidal wave of revenue.
Ah, I see.
So if you fundamentally believe your own company is drastically undervalued, the highest possible return on investment, better than any immediate R&D spend, is buying your own stock before the rest of the market wakes up to the reality of the turnaround.
Is the ultimate bet on yourself. Like, if you know the engine is fixed and you're confident you're about to win the race, you place the bet today while the odds are still wildly in your favor.
Exactly. You capitalize on the market's current myopia.
Doing so builds immense shareholder value instantly because, when those larger future profits do roll in, they are divided among a significantly smaller pool of total shares.
And the two strategies are not mutually exclusive. They can still fund the EV subsidiary through their standard operational budget. But at 10.48 a share, the buyback is simply too lucrative an opportunity to ignore. It is a tactical exploitation of market timing.
So what does this all mean for you listening right now? Why does a deep dive into a heavy-duty auto parts manufacturer's year-end earnings report matter?
It's a fair question.
Even if you never invest a single dollar in an automotive stock or you don't even know how to open the hood of your own car, this document serves as a masterclass in the gritty reality of business survival.
It illustrates that enduring success in a physical industry requires far more than just the good product. It requires profound operational resilience.
Exactly. It proves that mastering the boring internal plumbing, like maximizing your brake factory capacity to gain pricing power or healing your cash flow so you don't have to take predatory payday loans on your own invoices, that can literally rescue an enterprise from a $19 million deficit.
Right.
It highlights the macroeconomic gymnastics required to navigate global tariffs, where you are forced to pay the higher price for months before you can legally pass it on to the consumer. And above all, it showcases the immense power of strategic patience.
Yes.
Watching a competitor go bankrupt, letting the market gorge on the cheap liquidated leftovers, and just quietly positioning yourself as the indispensable high-volume partner when the feast inevitably ends.
The turnaround is undeniably impressive. But if we want to leave the listener with a final thought to mull over, we really have to look past the 2027 projections.
Oh, totally.
We have to examine the very foundation of what Motorcar Parts of America actually does, because their lifeblood is remanufacturing alternators, starters, brake pads, and rotors for internal combustion engines.
The complex, greasy machinery that powers the roads today.
Yes. But as the world steadily transitions toward electric vehicles, the underlying supply chain is facing an existential evolution.
Oh, so.
While EVs famously have vastly fewer moving parts, they simply do not require traditional alternators or starters.
Right, because there's no combustion engine to start.
Exactly. Furthermore, because they utilize regenerative braking, which is using the resistance of the electric motor itself to slow the car down and recapture energy, the physical brake pads on an EV experience a fraction of the wear and tear.
Oh, wow.
Those pads can often last the entire life of the vehicle.
Which means that the flow of cores,
Yeah.
those broken, worn-out physical parts that consumers return, which we established, are the absolute foundation of MPAA's remanufacturing revenue that could eventually slow to a trickle.
Yes.
If parts don't break, there's nothing to rebuild.
And that is the final, lingering question. MPAA has successfully engineered a brilliant, highly profitable turnaround today. They are about to experience a massive windfall of cash and market dominance over the next 12 months. But how will traditional aftermarket giants use this current influx of capital to pivot and survive the slow, inevitable decline of the internal combustion engine?
The engine is roaring right now, and the balance sheet is very healthy. But they have to ensure they are not just perfectly tuning a machine that the rest of the world is slowly preparing to leave behind.
It's the ultimate test of corporate longevity. They turn the key, the engine caught, and it's running beautifully today. The only question left is, where are they going to drive it?